buy the right stock at the wrong time, you lose. Buy a great stock when it's hated, you win. Right now, 5 solid dividend stocks are trading at their lowest point all year, and history says this is when smart money makes millions. In this video, I'll show you and John 5 rock-solid dividend stocks that are trading near their 52-week lows. I'll break down why they're down, why they're still strong, and how much your money could grow if you invest $10,000 while the prices are low. I'll show you a 52-week low stock that pays around $60,000 in annual dividends, and in the end, I'll show you a 52-week low stock that turns this one-time investment into a portfolio worth over $4 million. But first, let's all get on the same page here. What is a 52-week low, and why does it matter for you? The 52-week low is the lowest price a stock has hit during the past year. It's like catching a stock at its clearance sale, but don't confuse low price with low quality. Smart investors know the difference. When solid companies hit their 52-week lows, it's often due to temporary problems or overall market panic, not because the business is broken. So why should you care? Because buying at this level can be one of the best long-term investing moves you ever make. Let's say a company has strong fundamentals, pays regular dividends, and shows solid growth potential, but it's trading near its yearly low. That is your signal. You're getting in when others are scared, and that can supercharge your returns over time. Think of it like shopping during an off-season sale. The product hasn't changed, it's still very high quality, but now it's available at a discount because everyone's too distracted or nervous to buy. But not every 52-week low is an opportunity. The trick is separating the companies with long-term value from the ones that are in real trouble. That's what I've done. I've handpicked 5 dividend-paying stocks that are financially solid, temporarily beaten down, and set to reward patient investors. So let's start the countdown. Coming in at number 5, I've got Watsco, ticker symbol WSO, which is down nearly 20% from its recent high. Now, I get it. Air conditioning, heating, and refrigeration equipment might not sound like the most exciting corner of the market, but behind the scenes, this company is crushing it. Watsco is the biggest distributor of HVAC equipment in the United States, and that alone gives it a serious edge. But what really makes it stand out is how it's blending a very physical business with smart digital tools. It's not just selling parts, it's building an ecosystem that makes life easier for the 375,000 contractors who use its products. That is a huge base of repeat customers, and it's growing. Last year, Watsco saw a double-digit growth in both residential and commercial HVAC sales. Not because of a fluke, but because they've nailed the fundamentals, winning new customers, pricing smart, and steadily taking more of the market. And let's be honest, as the planet keeps heating up, HVAC isn't going anywhere. It's becoming more and more essential. But here's where it gets better. Watsco has developed mobile apps and tools like On-Call Air that let contractors quote jobs faster, track inventory, and close deals on the fly. Just last year, that platform processed over $1.5 billion in quotes. That's a serious revenue engine. Their digital sales alone now make up 35% of the business. Plus, they're staying ahead of the curve when it comes to environmental rules. With new regulations pushing for eco-friendlier refrigerants, Watsco already has the compliant products ready to go. That gives them an advantage when other suppliers are scrambling to catch up. And here's something investors love to hear. They've been paying dividends for 34 straight years, and they've increased them for the past 11. So even when the market zigzags, Watsco keeps putting money in shareholders' pockets. With a dividend yield of 2.62%, 15.62% dividend growth, and 13.9% annual share appreciation, this is slow and steady wealth building in action. Let's look at what those numbers could turn into if you started today. Let's say John puts $10,000 into Watsco today and reinvests every single dividend he gets. His investment after 1 year will be valued at $11,652. Fast forward 10 years and it'll be valued at $46,980. Stretch it to 20 years and John's portfolio will be worth $230,871. And by year 30, his initial $10,000 is projected to reach $1,196,458, paying around $43,489 in annual dividend income, or about $3,624 in monthly income. Out of that, $261,565 would come from reinvested dividends and $924,893 from capital appreciation. So the total value added to the initial investment would be $1,186,458. At number 4, I've got D.R. Horton with the ticker symbol DHI, down 5.56%. When you think about real estate, the last few years have been a roller coaster. Prices soared during the pandemic, driven by record low interest rates and a mad rush for space. But that post-COVID frenzy has cooled off. Today, mortgage rates are high, inventory is tight, and homes are out of reach for many families. So where does that leave companies like D.R. Horton? In a surprisingly strong position. D.R. Horton isn't just any home builder. It's the largest one in the U.S. by volume and has been since 2002. Over the past 4 decades, it's built and closed on over 1 million homes. That's not just market presence, that's dominance. And with operations in 118 markets across 33 states, they've got geographic reach that shields them from regional downturns and helps them ride national trends. The company focuses heavily on entry-level homes, properties that are more affordable even in a tough rate environment. While competitors choose luxury buyers, Horton keeps its eye on the broader market. That's a major advantage when affordability becomes the top concern. Beyond single-family homes, they're active in townhomes, duplexes, and multifamily rental units. They've even built out a rental property segment where they develop and then sell entire communities in bulk, a strategy that's gaining traction with institutional investors looking for large-scale housing assets. And this diversification plays directly into resilience. By having multiple revenue streams, D.R. Horton isn't dependent on any single segment of the housing market. So while overall home sales may wobble, Horton can lean on rentals, bulk sales, and geographic diversification to balance things out. Now let's talk about performance. Over the past 10 years, D.R. Horton stock has returned about 16% annually, beating the S&P 500. It shows that investors who stuck with this company during the ups and downs of the housing market were rewarded handsomely. That brings us to dividends. While housing is cyclical, Horton has proven that its payouts are not. The company has paid dividends consistently for 10 straight years and increased them every year during that time. That kind of commitment to shareholders is rare in a sector known for its volatility. They have a current dividend yield of 1.34%, and they've grown dividends by 19.62% annually, while the stock has appreciated on average 15.5% every year over the past 10 years. So what does this look like in dollars? Let's say John puts $10,000 into D.R. Horton today and reinvests every single dividend he gets. After 1 year, his investment would grow to $11,689. Fast forward 10 years and it'll be valued at $48,746. In 20 years, John's portfolio will be worth $254,157. And by year 30, his initial $10,000 is projected to reach $1,463,698. Paying around $52,059 in annual dividend income, or about $4,338 in monthly dividend income. Out of that, $269,235 would come just from reinvested dividends, and $1,184,463 from capital appreciation. So the total value added to the initial investment would be $1,453,698. An absolutely solid return, but there are even better options coming, like a stock that pays $60,000 in annual dividends. In the end, I'll show you a 52-week low stock that turns this one-time investment into a portfolio worth over $4 million. Okay, back to the list. At number 3, I have Pool Corp, with the ticker symbol POOL, down 18.42%. Now, pools might seem like a luxury, but in states like Florida, Texas, and California, they're practically part of the lifestyle. And when homeowners invest in lifestyle upgrades, Pool Corp is the name behind the scenes, making it all happen. They are the world's largest wholesale distributor of swimming pool supplies, equipment, and related products. While that may sound niche, the company touches a surprisingly wide array of businesses from leisure and outdoor living to irrigation and landscaping. And that diversification has helped it weather economic cycles with steady growth. In the first quarter of 2025, Pool Corp delivered over $1 billion in net sales. That's no small feat, considering the broader economic slowdown. What's more impressive is that this wasn't driven by pandemic-fueled demand, it was the result of years of smart expansion, investment in digital infrastructure, and a relentless focus on customer service. A major driver of Pool Corp's strength is its digital platform, Pool 360. It's a fully integrated ecosystem that gives customers real-time access to product data, order history, pricing, and availability. This tech-forward approach gives Pool Corp a huge advantage over smaller competitors who still rely on manual systems. And as more customers shift to online ordering, Pool Corp is scooping up even more of the market share. Financially, they're rock solid. Pool Corp has raised its dividend for 14 consecutive years and hasn't missed a payment in 20. That kind of consistency is rare, especially for a company tied to consumer discretionary spending. It's proof that their model works and that management is committed to rewarding shareholders even in lean times. And even though their share price has pulled back down over 18% from its 52-week high, the fundamentals remain strong. That drop presents a clear buying opportunity for long-term investors. A 1.65% dividend yield paired with 18.09% dividend growth and 16.07% stock appreciation makes this a solid compounding machine. Let's see what this could mean for your portfolio. Let's say John puts $10,000 into Pool Corp today. After 1 year, he would have $11,772. 10 years from now, it would be valued at $51,801. Give it 10 more years, and in 20 years, John's portfolio will be worth $277,589. And in 30 years, his initial $10,000 is projected to reach $1,550,176, paying around $38,382 in annual dividend income, or about $3,199 in monthly dividend income. Out of that, $219,410 would come just from reinvested dividends, and $1,320,766 from capital appreciation. So the total value added to the initial investment would be $1,540,176. Okay, next up at number 2 is a company that may not be on everyone's radar, but should be. UFP Industries, with the ticker symbol UFPI, down 18.46%. This stock doesn't make the flashy headlines, but it powers a massive part of the American economy. They're in the business of wood, lumber, pallets, fencing, composite materials, all the stuff that supports construction, retail, and industrial packaging. Basically, if it gets built, boxed, or fenced, UFP is probably involved. What started as a small lumber operation in Michigan back in 1955 has grown into a diverse, multi-market powerhouse with operations across North America. Today, it serves three major markets: retail, industrial, and construction. That balance means when one sector slows, another can pick up the slack, giving UFP a resilience many of its competitors lack. One of the standout features of this business is how well it adapts. In its latest quarterly update, management reported steady month-over-month improvement in demand, especially as pricing stabilized across key product categories. The company has its eye firmly on efficiency, aiming to cut $60 million in structural costs by 2026. Their product strategy is just as forward-looking. UFP continues to invest in higher-margin, higher-growth product lines like wood alternative composites, value-added assemblies, and proprietary building materials. These are upgrades that drive customer loyalty and improve returns on capital. Even more impressive is their response to global trade challenges. Unlike many competitors, UFP doesn't rely on foreign sawmills. Instead, they maintain strong relationships with domestic and regional mill partners. That gives them more control over their supply chain and makes them more nimble when tariffs or disruptions hit. In today's unpredictable environment, that is a major edge. Their long-term strategic goals are also crystal clear. Grow unit sales 7 to 10% annually, ensure 10% of revenue comes from new products, and maintain EBITDA margins of at least 12.5%. These aren't pie-in-the-sky targets. They reflect the discipline of a company that's been through cycles and knows how to win over the long haul. And yes, this is a dividend stock. In fact, UFP Industries has paid dividends for 31 straight years and grown them for the last 12. Its dividend yield sits at 1.43%, but the real magic is in its 20.75% average dividend growth and 18.63% average share price gains. So how would this play out if you invested today? Well, let's say John puts $10,000 into UFP Industries today and reinvests every single dividend he gets. After just 1 year, his investment would already be up to $12,006. Give it 10 years and he's looking at nearly $62,980. Fast forward 20 years, that same investment will grow to $408,943. But here's the big one. After 30 years, that original $10,000 could be worth around $2,756,877, paying around $59,739 in annual dividend income, or about $4,978 in monthly dividend income. Out of that, $312,687 would come just from reinvested dividends and $2,434,190 from capital appreciation. So the total value added to the initial investment would be $2,746,877. Finally, at number one, topping the list, is a company that's right at the heart of the AI hardware boom. Applied Materials, with the ticker symbol AMAT, down 26.19%. So if you've heard anything about the future of tech, chips, or artificial intelligence, chances are this company is playing a key role behind the scenes. This company is at the core of the semiconductor supply chain, developing the tools that make next-generation chips possible. But right now, it's trading near its 52-week low, and that's a rare opportunity. Let's talk about the elephant in the room first. U.S.-China tensions have cast a shadow over semiconductor exports, and Applied Materials is caught in the middle. China has historically been a massive market for AMAT, accounting for nearly 43% of total revenue just a year ago. But by quarter two of 2025, that share dropped to 25%, with China revenue falling over 37% year over year. That is a sharp decline, and it's triggered a lot of concern among short-term traders. All of this because of tariff uncertainties. But zoom out, and the long-term picture is incredibly compelling. Applied Materials isn't just another chip company, it's a technology leader driving the next evolution in computing. Its tools are used to create gate-all-around transistors, high-bandwidth memory, and advanced packaging, three of the most critical components for high-performance AI chips. This isn't just theoretical. AMAT's revenue from advanced semiconductor nodes topped $2.5 billion last year, and the company expects that to double in 2025. The transition from traditional FinFET chips to GAA is a big deal. It expands AMAT's total addressable market by 15% and positions them to capture 50% plus market share in this space. And they're not stopping. The company is investing heavily in R&D, including a new $4 billion EPIC Center in Silicon Valley, which will supercharge development in chip packaging and materials science. This is a strategic positioning for the next decade of semiconductor dominance. Let's not forget financials. Applied Materials delivered a gross margin of 49.2% last quarter, the highest since 2000. Analysts are forecasting steady revenue and earnings growth for 2025 and 2026, and AMAT has beaten earnings expectations for 4 consecutive quarters. When you pair innovation with financial consistency, you get a stock that is built to lead. From an income perspective, AMAT is no slouch either. It has paid dividends for 19 years, increasing them every year for the last 7. It has a dividend yield of 1.13%, a 15.29% dividend growth rate, and a massive 21.99% average share appreciation, putting this in high growth territory. So let's see how that plays out. Let's say John puts $10,000 into Applied Materials today and reinvests every single dividend he gets. After 1 year, his investment would grow to $12,312. In 10 years, it'll be valued at $78,193. Fast forward 20 years, and John's portfolio will be worth $590,736. And by year 30, his initial $10,000 is projected to reach $4,386,637, paying around $5,431 in annual dividend income. Out of that, $43,205 would come just from reinvested dividends and $4,333,431 from capital appreciation. So the total value added to the initial investment would be $4,376,637. Don't have the initial $10,000 to invest? Click the video on the screen to find out how to make $6,000 a month with only $20 per week.